This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Interested in learning more about investing in startups, launching a new startup and need to raise funding? The Startup Funding Espresso is a daily podcast in a short, concise format delivered to your inbox every day, Monday through Friday. In the time it takes to drink an espresso, you can learn about startup funding. To subscribe, go to investorconnect.org and put your email into the pop-up box. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Carl Grant, EVP of Global Business Development at Cooley. Clients partner with Cooley on transformative deals, complex IP, regulatory matters, and high-stakes litigation where innovation meets law. Carl, thank you for joining us.
Absolutely. It's my pleasure.
So what was your background before you started doing your current position?
Well, I started out as an entrepreneur. Unlike most of my colleagues when I graduated from my MBA back in the early 90s, most of them went out and took middle management jobs in big companies. I went out and tried to start a business. And as most of us know, not all these business ventures are successful. So the first one was a bootstrap business I tried to do with my dad. And we got bits and pieces of the business up and going, but not the whole thing. And, that was, and the main reason was that we were not able to raise the money that we needed to build this business. It was a capital intensive business in the cable television industry back then. And so I had to go to work in economic development. I managed the capital attraction program for an economic development authority, where I built up a tremendous network of venture capitalists all around the U.S. Did that for a couple of years, worked at PricewaterhouseCoopers for a couple of years, was in the eye of the storm in the late 90s in the internet boom. And then I joined the management team of the first company to put video over the internet and was an operator there. We raised a $36 million Series A round. Unfortunately, that money arrived the week the market crashed. You can't time these things. Look, we were dead in the water. We didn't know it. It was a great experience. Did that for a year. The market just was not there for us yet. And then I joined a buddy of mine's early fintech company after that. We doubled revenues during the time that I was there. 9/11 happened, caused some erratic behavior in our investors. And they pulled out of our Series B round, told us to cut everybody's salary in half, put the company into a tailspin. And at that point, my wife, who had 4 of our 5 children at that time, asked me, please don't do any more startups while I'm raising these kids. And so I joined the law firm that represented both of those companies. And I've been here doing business development ever since.
Great. Well, that's quite a journey. Well, given where we are today, what excites you right now?
Once an entrepreneur, always entrepreneur. And I feel like I was prepared to do my life's work in those experiences and not being able to raise capital early on in my life. I really set out to help companies capitalize their businesses. And that's what I've been doing. And I have a team of people all over the United States and overseas that help companies do that. That's not all we do. We help them build their companies. We help them strategize. We help them get connected to key advisors and employees. When we say business development here, it's really about developing their businesses. And then it comes back to help Cooley because there's a legal component to everything that's done.
Great. Well, it sounds like now's a great time to start a business. We're coming out of COVID, whole new set of careabouts. The market's rocketing upwards at the top of the market right now. So it just seems like now's a great time.
Yeah. So, once again, you cannot time markets. We're long overdue for a correction. COVID was kind of an artificial correction. So having launched businesses into bad situations, the tech meltdown, 9/11, I was a founding board member of a bank in 2007. We all know what happened in 2008. You never know what's around the corner. So there's never a bad time to start a business. But you really need to think about how you capitalize that business and be aware of what could be around the corner because you don't know. Nobody could have, really forecasted COVID and all of the craziness that came this past year. You really had to adapt. So you have to think about contingencies when you start a business, and you got to think about don't assume you're going to raise money 6 months from now. The markets could be closed 6 months from now. You got to build a business that's going to be sustainable 6 months from now.
Well, you've raised money before and you've actually invested before. What's your advice for people investing in startups? What do you tell them to do before they write that check?
Well, the market has changed a lot since I've been doing this. When I started out, you could have a good idea and a web domain and raise $3 million with a story, right? Hardly even had to have a slide deck back in the late 90s. Things have really changed over time. You really have to have a fundamental business model. And I say that that's really on the technology side of things because we do half of what we do is in life sciences. But even then, there's certain metrics that you have to hit. And so investors need to look at companies that have a plan, not just pie in the sky stories and slideware, but a fundamental business model with real customers that they're solving real problems for, where there's real pain, and it's going to be sustainable. It's not a nice to have.
Well, also, so what's your advice to people who are running startups? What do you tell them to do before they go out to raise that funding round?
Well, a lot of startups will go out and they will want to raise their money before they start to execute on the business plan. And I understand that because it takes capital to do these things. But nowadays, that's not what works. What works is going out and starting to execute on the business plan. I think we've come back a little bit from that $1 million of annual recurring revenue requirement. A lot of the investors I talk to nowadays don't necessarily need to see that. Some of them still do, but they want to see a finished product. They want to see customers using that product, referenceable, and saying that they will continue using that product, and then it's something that they need. So if I were an entrepreneur, I would figure out how to get into the market with your product, with customers using it, paying you. And, sometimes you have to have a second, keep your day job. Sometimes you have to be doing consulting work on the side or have some money saved to do these things. I would say it's important to do that even before tapping your friends and family, because you can get undisciplined as an entrepreneur if you go and you raise that money from friends and family out of the gate and you don't start executing on that business plan.
Well, that's great. That's good advice. It's always good to have validation of the product in the market before you go out to investors, because they'll look for that as well. How much validation do you think investors would need to see before they'll write that check?
So it varies with every investor I talk with. I have been going through and updating investment criteria with investors. So during the COVID shutdown, I'll tell you a little venture that I worked on. I got overrun with deal flow. I would typically help about 2 companies a week with their capital raises. Well, all of a sudden, all of these companies that used to be able to get out to conferences and fairs and be able to meet investors face to face and bypass these warm introductions weren't able to do that. And so many of these companies ended up in my inbox and in my team as well. And so the way deal flow has been referred from people like me to investors has not changed since the late 90s. I mean, it's been over 20 years. And I realized that this has to change. And COVID exacerbated the problem. And so I worked with others, a team of people, and we've pulled together a platform called Venture Raise that is, it's kind of like a LinkedIn platform that helps companies identify which investors are a good fit for their company and who they need to get to know to get properly referred to those investors. And so we pulled this thing together, collaborated on this, and I've been using this now to get these proper referrals into venture funds. And it's starting to get adopted by others out there. So it's ventureraise.io if you want to go visit it.
Well, great. So how does that help startups and growth companies in specific? It gives them the introduction, and what else?
Yeah, well, what it does is it levels the playing field. So if you think about it, the venture capital industry has been kind of a clubby industry over the time that I've been in it. And if you're a disadvantaged person coming out of some Midwest state, you really don't know even where to begin. You could Google venture capitalists and try calling one of them. Good luck. I mean, it's really hard to break into. And the venture industry has suffered as well during this period because there's increased pressure, greatly increased pressure for them to diversify their investments into women founders, minority founders, underrepresented entrepreneurs. And what this platform does is it allows these entrepreneurs to be able to come on and figure out what this world looks like, who invests in what, and then who do I need to get to know? Who do I need to build relationships with? Is it somebody at a bank, a law firm, an accounting firm? These are the trusted sources of deal flow, the connectors in the world. And this really opens it up. In fact, there's even boxes you can check when you're setting up your profile to say that I am a female entrepreneur. I am an underrepresented entrepreneur. And investors can also check if that's an investment criteria. And there are funds set up today to invest solely in female entrepreneurs. I talked to one last week that is focused solely on female entrepreneurs, and half of their fund is set up to invest in underrepresented entrepreneurs. So those are minority female founders. And so this is new. This is not something I've seen in the 2+ decades that I've been in this industry. So this really helps to navigate those entrepreneurs into those sources of capital that are sympathetic to their stories.
Well, that's great. So in Venture Raise, you're actually helping the entrepreneur figure out how to get the connection to the investor. And then the entrepreneur goes and actually makes that connection themselves and follows it up and carries it forward. Is that right?
Well, they get the introduction by gaining the relationship with that trusted source of deal flow. So if somebody comes to me off the street and I don't know them, that network of mine is something that's highly protected. I'm just not introducing just anybody off the street. They've got to convince me that they have a good business model, and they're the right person to execute it. And so that's what it's opening up. It's opening up, my inbox for those individuals to come and get to know me or one of those other trusted connectors.
Well, that's great. So you see a lot of startups, and I guess so what is the main challenge you find they face today in this very exuberant stock market? What's the challenge that startups have to overcome to get to the top of that list for investors?
So naive founders, I should say, come in hearing these unbelievable valuations and these stories. They read about it in the tech press, and that you can't enter the market and say, "Oh, this guy got a $50 million valuation," or whatever. I mean, a $1 billion exit. You can read those stories, but that's not their reality. If you haven't done this before, you're not part of that yet. To come out and get an unreal valuation, it's usually somebody who's done it before. So I would say that as a startup entrepreneur, sometimes it's a good idea to try to team with others who have had successes in the past, because that will rub off on you. It'll help validate what you're doing. And so if you haven't done it before, you're going to have to pay your dues before you're able to go and get those kind of valuations and raise that kind of money. So you can't buy into the exuberance. You still have to prove out your business model and build a good team. Surround yourself with people who have had success in the past.
Yeah, the PR community really is a little bit misleading. It looks like everybody's raising funding, but the reality is it's less than 15, less than 20, maybe even 15%. If you include angels in there, actually fund startup deals. The rest have to bootstrap or do something else. Is that what you find?
Absolutely. I would say it's even less than that number you just threw out. It's a very small fraction. And I tell you, when you're raising angel money, my experience has been, so I have a long list of angels that I've known over the years, and they're not those angels are not just parting with their money for some idea out of the blue. You have to really think about it. You're not competing with other entrepreneurs for the angels' money. You're competing with a vacation home, with college education for their kids, for whatever their hobbies are. Right? I mean, that's their money. They don't have to part with it. It's not like a venture fund that's raised money and says they're going to invest this money and have told limited partners they're going to invest it. So you need to think about, when you're going out to raise angel money, really, you need to talk to people you already know, because or people who know the people you already know, if they've already committed to invest, because the build up time and the get to know you time is reduced by about 6 months. I have actually had angels say to me, if I'm going to do a deal, I'm going to spend 6 months getting to know this entrepreneur. 6 months is a long time. Just think about, if you don't know that as an entrepreneur going into the process and you've got a 6-month get to know you process, rather than focusing on pitching that angel, you could be out selling your product, getting companies to agree to pay you to develop a custom solution to some problem that they have. I mean, there's a lot of things you can do to be getting money in the door other than waiting on that angel who may or may not, at the end of 6 months, invest in your company. Whereas if you're talking to a friends and family, they already know you and they're going to invest in you for reasons other than it's the best thing they can do with their money, right? Investing in a startup entrepreneur is risky. And there's a lot of other things you can do with your money that's a lot less risky, but they're going to put that money in what you're doing because they believe in you. They have a sense of belonging in what you're doing and they want to be part of it. And usually they're close by too. They're not far away. Just keep in mind that most of the angel investing I've seen throughout my life is within a 2-hour driving distance of where that entrepreneur is.
Right. So with angel investing and most investing, there's a relationship there. You have to build a relationship. They say it takes 7 touches to close a sale, so it takes at least 7 touches to close an investor, depending upon how much the funding is going. So how does a startup prepare for that challenge?
So what I tell startups to do is when you go out and you're talking to friends and family and people who might want to put money in your company, don't go ask them for money. Go out and show them what you're doing and ask them for advice. It's a great way to, one, get advice, but oftentimes when you ask for advice, sometimes it turns into money, right? I've shown what we're working on at Venture Raise to some friends, and they've said, you know what, when you're ready, I want to put money in this. And so we've got to develop a team. We got to put a team around this. I'm not leaving my day job to do this. This is something that was, built as a solution to a problem that I had and others. And so there'll be a team brought on board. But going and asking for advice, it causes people to step out and say, I would put money in this when you're ready, when you have a team, when you have customers. And so that's a good way to do this. If you go out and ask for money, sometimes you just get advice, right? And it puts the people you're talking to on the defensive if you're just doing a hard pitch for money. So I would go on an advice gathering tour and then take notes of who says they're interested, and don't circle back with them right away. Circle back with them when you're ready to put that round together. That's with the angel money, if that helps.
And who should the startup recruit to help them with that process as well? People that are connectors or maybe perhaps others?
Yeah. So when you're starting a business, there's certain service providers you're going to have to engage over time. You're going to have to engage a law firm. You're going to have to engage an accounting firm. You have to have a bank. You're going to have an insurance provider. These are must-haves if you're going to be successful. And what I would do is I would not think of these relationships as vendor relationships. I would think of these relationships as business partners, and really think about what they can do beyond the services that they will one day charge you for. Because a lot of these firms will pay it forward. And I've been a business development professional with PricewaterhouseCoopers and Cooley. In both of these roles, I had the type of role where I tried to pay it forward and help entrepreneurs in the hope that one day they would be successful and need to use our services. And so you'll find that with certain venture banks. You'll find that throughout the services industry. What we're trying to do with that platform I talked to you about is kind of capture that network so people know where to go find these people. It's in the early stages right now, but it's going to be a software representation of what happens in the regular world. So a lot of the things I've been talking about, leveling the playing field, these are things I've been doing all along. My team has always tried to help the underrepresented entrepreneur and the female entrepreneur and give them a leg up in the process because it's the right thing to do.
And one of my favorite techniques I saw an entrepreneur do is he came to me and said, I'm not raising money now, but in 6 months I will be. Can I keep you informed of our progress? And he basically gave himself 6 months of free runway to show progress, send out notes, build relationship before he ever asked for any money or had to show any real substantial, validation behind the product. And I thought that was a great idea to go and build the network first and then ask for funding second. What have you seen in that direction?
Yeah, you're absolutely right. That is a good process as long as you're not asking for money. Because if you ask for money too early, a lot of times you'll get turned down. And these bigger funds out there, they keep a CRM system, and they will put, rejected. And a lot of times you don't get a second chance to go back. I've seen this happen where you go back and you say, "Oh, we've already seen that one." And so make sure you're not going out with the pitch and an ask. With respect to, I'll think of one entrepreneur situation. I won't name the person or the company. The company's already exited. They were acquired. But when the founder was going out to raise the money and start the company, this is a founder who had already had 2 or 3 significant exits. And so I worked with this entrepreneur to put together a message to certain venture capitalists that he wanted to target for his future raise, just like what you were talking about. And I said, look, this person is starting up a new company. It's in stealth mode right now. This is what he's done. And I showed the exits. He's going to be in Boston, in your geography. When he's there, do you want to meet with him? And every one of them said yes, just based on the track record. And so he went and met with these investors and built the relationship. And then didn't ask him for any money. He didn't even tell him what he was doing, to be honest with you. And so when he was ready to raise, like you said, it was about 6 months later, he went and called those warm contacts. He raised it in no time at all. He raised over $3 million. And I don't think he needed a second round to get to exit. So it was a beautiful, beautiful plan. And it worked perfectly. And I was happy to be part of that.
You find second and third time entrepreneurs are able to do that every time if the first round was successful or had a positive exit at some level. Do you think that's universal, or do you think there's still other issues that come up?
There's still other issues that come up. I had an entrepreneur who had 2 fantastic exits and had a cool idea for a new business and went back to his existing investor to pitch it for a seed investment and was turned down. Not like 100% turned down, but like, no, we're not ready. Not yet. We want to see it proved out. So it's not universal. It's much more likely than it would be if they hadn't done it before. They'll get the audience, whereas you might not even get that audience if you hadn't done it before. But it doesn't guarantee that you're going to get the money.
I had one entrepreneur who came in, he literally had 3 previous companies go out for 9-figure exits each, and he was now raising his 4th one. And of course, he had a waiting list, and we were able to raise the money, substantial money, in about 30 days. You don't see that very often. But I found the clincher was the fact that it wasn't just the entrepreneur, but it was the entrepreneur and his team. It was the very same team that had done those other ones for the most part. And so I found that was the clincher that would work every time. If you had the same team working in the same space, it worked pretty well. Have you seen anything in that direction?
Yeah, you're absolutely right. That is the number one predictor of future success, is a team that has done it together before. As I had one investor in New York say, if you have a scenario when the band is getting back together, that's how he said it, show me those. In fact, those are the only emails he responds to from me. If I send him a message, I say, the band is getting back together, and he responds and says, yes, I want to meet them. Any other scenario, he doesn't even respond to the email. So yeah, you're onto something there for sure.
All right. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Well, look, if you're thinking about doing a startup, it's not easy. These things are hard. You've got to be prepared for, the rejection, the letdowns, the discouragement. If this were easy, everybody would do it. And so you've really got to think about what you're getting yourself into when you're doing a startup. All right. It's not for the faint-hearted. And you gotta realize that just because your business, you started out doing one thing, don't be so set on that one thing. You might find out in doing the thing that you were planning to do that you've solved another problem that is much bigger than the thing that you started out to solve. And so you got to be willing to pivot when that happens. You've got to be willing to change your team when necessary. You got to be flexible. Investors, the same thing. You're really betting on the jockey or the racehorse, if you will. You got to know that this person, while they started out doing one thing, like that one company I mentioned to you, that company I mentioned to you that went and raised that money after pitching it to those investors, before his first board meeting, he had to change the business model drastically. And so he raised the money and realized that he had, assumed one thing and the market had changed, but he was a good entrepreneur, right? That's the beautiful thing about a good entrepreneur. He had to change the whole business model, and he was able to convey that to his board and get them on board. And so you got to be ready for changing markets, changing scenarios, and you got to be flexible.
Well, that's great information. So how best for listeners to get back in touch with you?
Well, so it's best to reach me on email. My inbox is usually full, and so don't be upset if I don't get back to you right away. I'm at cgrant@cooley.com. And if I'm not the right person to help you, I've got a big team. It's growing. We've added 4 people this year. I will get you to the right person on my team to help you because we are specialized. We focus on different geographies and industries, but we're here to help you.
Great. We'll put that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you so much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.